Okay, it seems like you are alive, but since I've been having challenges with it, I'm just gonna go back to the channel to check that it is live and that it is recording the camera, because for a while I was struggling to see the camera. It was still trying to access another application. So I just want to quickly verify that before we proceed. Okay, from my side, it seems like I'm live. It's working as expected. Apologies for the poor quality of the camera. I don't have the best camera with me, so I'm just relying on the webcam. So what I wanted us to talk about is the question of whether it's possible to beat the market or it's not possible to beat the market. So where does this talk comes from? So earlier today, as I was browsing on Twitter, there was a poll on MoneyWeb. I think Simon Brown created that poll. Basically, Simon was asking market participant. I won't say it was just a question that was posed to traders, but the question was just asking people how did they perform so far this year in the stock market. As we know, the year is not over yet, but now it's December. Around this time, the market, there's not a lot of action that is happening in the market because people are going on holidays and people are just enjoying life. They are no longer focusing a lot in the market. So the timing of the poll, I think it will represent however people are going to perform from next week Monday until the end of the year. So of the three options that people had, one of the options was that people, yes, they performed well, they made money, or maybe they had average returns, or they didn't perform well, so they performed badly. So one of the guys there on Twitter actually retweeted that article which had the poll by Simon Brown, and then the guy made a comment to say that since we are in a bull market, if you didn't make money this year, then you are not a good trader, right? So good or bad trader are just relative terms. But yeah, the guy just said that if you didn't make money in this year, 2021, even though the JSE has been performing very well, like we said in previous videos, the JSE Top 40 and the JSE All Share, which is the All Share Index, they broke to new highs. We are in a bull market. If you had invested in the top 40 ETFs, you would have made money because the general market went up. So then I took a screenshot of this conversation. I shared it in our Telegram group to say that, yeah, I hope that at least we made some money since we are in the bull market, right? Then, yeah, there was a discussion around that topic. So now I want us to just talk about that now. The question of whether it's possible to beat the market, right? Short answer, yes, it's possible to beat the market. There are people who do it. Yeah, just as there are people who struggle to beat the market, right? So it's possible to beat the general market index. That is, if you benchmark your performance against the JSE Top 40 or the JSE All Share Index, then you look at the year-to-date performance, or let's just say 12 months period, starting from the beginning of January up until the end of December. Then you can look at that. The JSE returned, let's say, 25% for that particular year. Then if you are a DIY investor, then that means that you were selecting the stocks yourself or selecting the ETFs yourself. So now you want to get your performance against the performance of the general index. So now when you look at that, if the index returned 25%, now it becomes a question of, did you as a DIY investor or DIY trader, returned at least 25%, or you just returned 25%, or you returned less than 25%. So if you returned more than 25%, then you can say you did beat the general market index, right? If you return 25%, then you still make money for yourself. You didn't beat the market, you didn't underperform the market, you just returned whatever that the market returned. And then if you return less than 25%, you don't need to have a negative return to say that you underperformed the market, because if you performed at the same level as the market, at minimum, you would have returned 25%. Okay. So yeah, that was the conversation. So now a video was shared talking about how to build wealth, right? So in that video, the talk, among other things, it's about buying an index tracking fund, right? Back in the day, people used to invest in mutual funds. These days, we invest in ETFs. They are still mutual funds, but they don't carry the stigma that the previous mutual funds used to carry. These days, we know that ETFs, the costs are low. ETFs are more liquid as they can be traded in the open market. You don't have to wait for the market to close so that the asset manager can calculate the net asset value of the mutual fund. And then that's when you're going to know whether the mutual fund is performing good or bad, right? So now we know that if you buy a top 40 index or an all share index, of which is something that we recently have, or even if you buy an S&P 500 index or an index in the US that tracks the general market, all the stocks in the US market, you're not going to underperform, you're not going to outperform the market, you are just going to get not necessarily exactly what the market returns, because you have to subtract the fees, and also there are distributions that you'll be receiving. So now there we can just say, to make things easy, you can return whatever that the market is returning, right? So that's the part of one part of the conversation. The other part of the conversation is that sometimes the professionals like fund managers or asset managers, they can also underperform the market. Yes, there are some that outperform the market, but some underperform the market. Then it becomes a problem, because we pay fund managers to manage our funds. The least that they can do is to replicate the general market. If they fail to replicate the general market, then what are they doing? Or even as a DIY investor, if you spend your time investing and then you're not returning whatever the market is returning, the question is, why don't you just allow the professionals to invest on your behalf, right? So now it just goes back to say, before you even become a DIY investor, do you understand what it takes to be an investor? Do you understand what you need in life financially before you can invest? That is, if you go to a financial planner or a financial advisor, they will ask you certain questions, because they have a way that before they give you investment product, they need to ensure that you have some other products that they consider to be necessary in life. For instance, you could be asked if you have a life cover, a funeral cover, medical aid, those kinds of things. Then once the financial advisor is satisfied that you have some of those things to their satisfaction or according to the requirement by the law or FSCA, then they can start discussing with you the investment product where you can invest. One of the conversations that you're going to have with your financial advisor or financial plan is, you'll be looking at your goals, your financial goals. What do you aim to achieve? Maybe you just want to have a portfolio that will give you income, or you want to have a portfolio that will give you capital appreciation, like a growth portfolio. or you want to have a portfolio that will give you both income and growth. You see, so those are the things that you will talk about with your financial advisor. Then once your financial advisor has an idea of what you are looking for, then they can start recommending products that you can invest in. Those products will then at least give you a chance to meet your financial goals, right? I just want to check if we're still streaming there. Because like I said, technology is just doing its own things these days, so I don't want to waste my time to say that I'm streaming whereas I'm not streaming. So I just want to verify that before I continue with this talk. Okay. Yeah, no, the internet, it's a bit slow at the moment. Okay, it's showing that I'm still live. Then I'm assuming that people are on the road, so maybe that is why they are missing this live thing that is happening. But if you are there, you are watching live, just make sure that you can comment there. I will be able to answer your questions. But like I said, since I'm using the webcam, I won't be able to share the chat with you. What I can do is that I can look at the chat on the side and then answer your questions. All right. So by the look of things on my side, it seems like I'm still streaming. So if you're watching the stream, just click that like button to show that you are present and I'm not talking alone. Okay. So now let's go back to our conversation. So now I said that once you have discussed your needs with your financial advisor, they will be able to tell you the kinds of products that you can invest in, right? Then now there are fund managers. I'll just make use of an example of fund managers. We are not discussing particular fund managers, right? Let's say you go to Standard Bank, you have a financial advisor there at Standard Bank, then they recommend the products that are being sold by Standard Bank Libat. There is an income fund, there is balance fund or equity fund or property fund, or maybe even the top 40 fund or JSE All Share Index fund. Then you invest in that. So your expectation is that you are going to get the returns that the market gives, right? That's the best case scenario. The worst case scenario is that the fund managers, they underperform. We know it happens. There are many reasons why it happens, but the focal point is that can you beat the stock market if you're not buying the top 40 index or the all share index? Again, the simple answer, yes, you can beat the market, hands down. But what it takes to beat the stock market, right? You need to have a skill with everything that you do in life. You cannot afford to take chances. Let's say, for example, now you've made your investment with professionals, financial advisors, fund managers, and everything, you are sorted, but you still have that itch that you want to do it yourself, DIY investing or DIY trading. Then you take a portion of your capital, you open a stock brokerage account, then you trade for yourself or you invest for yourself. The assumption is that you'll be doing your own research so that you can find companies or securities where you can invest so that you can grow your money, right? If you have that, if you are invested in the mutual fund, you have a winning chance. It doesn't matter how you perform. If you perform great, you'll be growing that capital that you're investing. Also, the money that is invested with the fund manager will be growing, right? But if you decide that you are just going to do everything 100% by yourself, you don't have any other investment besides the stock brokerage account that you trade or invest yourself, then there are so many outcomes that you will come across. If you underperform the market, the question is why you are doing it, because clearly you are not doing a good job. You might as well delegate that job to somebody who has a better chance of beating the market? Well, not of beating the market, because we're talking about a general index here. So there's no way that that person is expected to beat the market. But at least if you are in the bull market and the market is up by 20%, you will also be up by 20%. If you are in a bearish market and the market falls by, let's say, maybe minus 10%, you will also be down minus 10%. But as long as you stay invested, when the market recovers, your money will recover as well. You will break even, and then it will continue to grow. As long as you stay invested, and if you can still afford to make monthly contributions, that's the best way that you can invest in. But should you decide to do DIY investing, make sure that you have the skill. You know how to trade, you know how to analyze the stock market, and also at the same time, you need to be aware that it's possible that you won't beat the stock market. And what happens if you don't beat the stock market? Then if the market returns 25%, you return less than 25%, then you are missing out on compounding interest. You understand? So that is something that you have to keep in mind, and that you have to prepare yourself emotionally. How are you going to deal with such event? Okay, because I mean, you wouldn't want to do it on your own and still do a not so good job. I can't swear, I'm on YouTube, so I have to keep the language clean. Okay, so that's that. But the answer is simple. You can beat the market. You need to know what you're doing. You need to manage risk. You need to have an approach that has an edge in the market. What is an edge? An edge is a positive expectancy. You don't just wake up and have a positive expectancy. Positive expectancy is based on your results, right? Meaning, if you were looking at, okay, I don't see that there are people that are attending this thing. Let me just check on Facebook if the members, because we did stream there. So I just want to make sure that people are aware that we are streaming so that they can watch, because at the end of the day, I don't want to talk to myself, right? So if you see this, it pops on your timeline, just make sure that you join the streaming. I will leave this on YouTube so that you can follow it on your own, right? So now we are doing DIY investing. You know what you are doing. You know risk and money management. You have a strategy that has a positive expectancy. Now your job is to just beat the market. That should be your goal. At the beginning of the year, we don't know how high the JSE is going to go. If it goes high, if it goes down, we don't want to be there if it goes down. So from the beginning of the year, you need to set your goal that, okay, on average, the stock market returns between 8 and 12%. Well, that's what most books says, but the information, the data point, they change every now and then. So the percentages, they have changed now. I mean, last year we saw the S&P 500 was up over 20%. Even this year, S&P 500 is up over 20%. So we can't really say that the market can only give us between 8 and 12%. So if we're just going to continue with that 12% thinking, then from the beginning of the year, you set yourself a goal that, okay, for this particular year, I want to return at least 30%, right? So when you go to the market, you have your well-defined set of rules. How are you going to trade the market? And what are you going to trade? Because the market has everything. There are stocks, there's cryptocurrencies these days, there are indices, commodities, there's even Forex. Then you decide that I'm going to trade this particular market. I'm going to trade this time frame, whether it's a weekly time frame or a daily time frame, or even a short term, because some people, they are day traders. Okay, so you have specified the time frame where you'll be trading at. From the beginning, you don't concern yourself about the market, what the market is doing. You are just looking for opportunities that meets your set criteria, right? So that means that there are some companies that you are going to miss, right? Because you want the very best companies that meet your criteria. Why you want the very best companies? If you buy every other company that people are hyping for whatsoever reason, then that is out of your strategy. Unless if your strategy is to buy what the general public is hyping on social media or wherever you are getting your tips on investing. But if you have your own plan, you know what to trade. Let me make an example. If your strategy says buy ArcelorMittal, you are just going to buy ArcelorMittal. It doesn't matter that somebody outside of your mind is talking about Kumba Iron Ore or Exaro, or you're talking about Tunnel. And yeah, so number one, you really need to stick to your own strategy. Then once you are stuck with your strategy, you are sticking with it, you are trading with it with discipline, then you increase the chances of beating the general market, because you know what you are doing and you are doing it, and you are doing it with discipline. You see? Then at the end of the year, then you look at your result, you compare your result with the index, then you have beaten the index. If you can do that for 2-3 years, then you will be ahead of the market, because like I said, if the market is only returning 12% per year and you are able to return at least 20% per year, or even if there is a bear market, the stock market, it crashes, it falls, maybe let's say it's down by minus 10%, and you close your position, you sit on cash. Hopefully, when you close all your position, you don't dip below your starting capital for that particular year. It's either you break even or you're just slightly above. Then still, again, you have beaten the market. You didn't return 20% as you would have wanted, but you returned much better result compared to the general market. And then the following year, the market has to play catch up, because it first has to cover the drawdown that it did the previous year. So it has to move from minus 10% and go to positive to zero. There's nothing as positive or negative zero. Zero is zero. So it has to start from negative 10%, then it goes to zero. Then it goes to plus 1% and it moves up. By the time the market does that, you are already making money, because you were not losing money. There's no way that you lost money. You protected your capital. You are not starting at zero like the market is doing, that it is starting at zero. Then another thing that can give you a chance to beat the market. Remember, the market, it goes up, goes down, goes up, goes down, goes up, goes down, right? Every time it goes down, we call that a drawdown. So if you can reduce the drawdown, your equity curve will go up. It won't go up forever. It will go up. Then the market is not behaving nice. Your stop loss get hit. Then your equity curve should be flat during that period if there are no trading opportunities. Once the trading opportunities they come, then your equity curve will start to move. It can go up or it can go down. Your job as a DIY investor or a DIY trader is to minimize your drawdown. And the only way to reduce your drawdown is by risk management, by taking your stop losses. I know there are some people who believe that if you just buy and hold and do rent cost averaging, each and every month you buy, each and every month you buy, each and every month you buy, then when the market is falling, you get more shares or ETFs. When the market is going down or up, you're getting few shares. Yes, that strategy works. As long as you keep on piling up cash into your investment, in the long run, you are going to make money. But that is average performance, right? The question that you should ask yourself as an individual, do you want average result or do you want to beat the market? If you want to beat the market, then you need to learn how to trade and how to trade better, and make sure that you just beat the market. You always outperform the market. That is the only way you are going to be extraordinary. But if you want to be an ordinary person, just take your money, give it to fund managers or ETFs, then your money is going to be growing there. But I'm not saying that you should always push to beat the market. It does not always happen. So how do you at least protect yourself that if you underperform on your own, but you still grow your investment? You use capital allocation. That is, let's say you have 10,000 rand to invest in the stock market. You can take 50% of that money, put it in an ETF, index tracking, low cost in terms of TR. You put your money in there, then you're paying 0.1% annual, not per month, 0.1% annual. That 50% of your capital, hopefully it's going to grow on its own. Then your job is to focus on the 50% where you are doing that DIY investing. But also there's a catch. If the market returns 25% and you are a super trader, you return let's say 35%, then your result won't reflect your super performance of 35%. It will reflect the average performance of the ETF performance or the index performance and the performance that you did yourself. So that is something that you should always keep in mind, right? Beating the stock market is nice. It feels great when you return more than what the general market did, but also be careful that it does not give you a false sense of like you feel like you are on top of the world, you can beat the market, because what matters in the market is longevity. You can beat the market this year, then the following year it beats you. You see, so you don't want to be, what do you call this thing? You shine this year, the following year you fail to shine. There is a book, it's written by an American guy. One year, that guy, he beat the market. He had incredible result. He published a book. Then the following years, he just couldn't replicate the result for that previous year. So that is why it's important that you get a professional advice from a not a fund manager, from a financial advisor or a financial plan, and you stick to those investments. You know, when you're on FinTweet, everybody's talking about the shares that they're investing in. Yes, that is nice. Everybody wants to do DIY, but also the very same people, sometimes you'll see they'll be talking about retirement annuity or some funds that they have this fund manager, whether they are happy with the performance or they are complaining with the performance. What should come to your mind is that no one is investing in one thing. If you invest in one thing, yeah, well, I'm a firm believer that you need to concentrate your capital. You need to put all your eggs in one basket, but it does not work all the time. So, yes, like Warren Buffett says, diversification is for those who don't know what they are doing. But how many of us actually know what we are doing? You see, I also, I mean, I have an idea of what I would like to do in the market, but the question is, am I doing it to the extent that I would be say, I now I'm confident that I need to manage all my money without having the assistance of ETFs or other people that are more experienced than me. You see, but if it was a perfect world, you will take all your money, put it in the stock market, and trade it yourself and beat the stock market. But the world is not perfect. And yeah, so that's what I wanted to talk about. That yes, it's possible to beat the stock market, but not everyone can do it, including the professionals. There are some professionals that are really, really struggling to beat the market. We always read horrible stories from investors. Fine, some fund managers, they just fleece off people's money with expensive fees, but some fund managers, they just can't crack it. I mean, I'm not talking about, because here we want to compare apples with apples. If we're looking at a balanced fund, so basically a balanced fund is a fund that has equity investment, then there's bonds, maybe there's some property or fixed income type of things. So there are some fund managers that don't return returns that will make the investor want to stay. Yeah, so there are professionals that really suck. We know, we always read about it in media. Let's look at PIC. PIC is Public Investment Corporation. It's a state-owned entity. They make investment. I'm not saying that they are not good investors. We've been reading in news that they invested in a certain company. Their investment they had to write off, meaning they lost money in there. We can also write off some of our investment. If I take my money, I buy nutritional holdings, and it's just not moving. I'm not saying nutritional holdings is not moving. I'm just making an example. And then that stock is not moving. Then I'll be forced to write off that investment. Or you make an investment to a particular company, the share price it drops to a point that the share trading or that share is suspended from the JSE. Once the share is suspended from the JSE, there's nothing you can do. You can't exit. You are stuck with that. So to make your life a bit easy, you have to forget about that particular investment and write it off. So it happens with everyone. There's some bad investment that Warren Buffett consider himself that he had made some of the bad investment. And there are so many people that have made bad investment in the past. The only way to try and minimize the chance of investing in a bad investment is to diversify a bit. But I'm just gonna wrap it up here because you see, we keep on getting one or two people, they come and go, they come and go, they come and go. But I will just end the streaming here. Maybe next time when we stream, we'll have more people, but we'll try to schedule it. For today, I was just testing the network and also testing the PC. Clearly, the network seems to be working fine. What is not working? It's a PC. I need a better PC that is better spec'd, that it can handle to record and stream at the same time, because the one that I'm using at the moment it's struggling. Also, the webcam that I'm using, it's only 720p. I'm not even sure if YouTube is going to convert this video and make it to be at least a bit of a high definition, because right now when you're looking at me, it's like I'm recording this on a Mobicel. Okay, so if you have any questions regarding beating the market and how can you, okay, the only way that you can increase the chance of returning average result, but I've already mentioned this, you can just buy a low cost index tracking ETF. In South Africa, we have Satrix 40. It's the cheapest top 40 tracking ETF. The total expense ratio there, it's 0.1%. There are some other companies that offer that top 40 ETF, but their total expense ratio, TR, is greater than 0.1%. In the US, there is Vanguard ETF. There's one that tracks the S&P 500. It's called VOO. We have a video there. We will include the link to that video in the description of this video so that you can just click there and watch that video. So you can buy that VOO, which is the S&P 500 tracking ETF, but also there is VOOG. So that one is a bit biased to the growth stocks. Right. Then another thing, just one last comment so that this thing can end. Remember last year there was this ARC Innovation ETF that performed very well because the tech just did wonders in 2020. So now, as a person who wants to grow your money and get the best return that you can get from the market, do you think that for 2020 it was the best idea to buy an ETF like SPY 500 or VOO compared to ARC Innovation? You see, ARC Innovation doubled in price in 2020, but the VOO didn't double in price. But before you get excited, ARC Innovation, for the most part of 2021, it has been flat, and now it's negative for 2021. On the other hand, the VOO is up over 20%. I'm not sure of the actual figure, how high it is, because on my portfolio I've been averaging on it, so it's up an average of 20%. But if you just compare from the opening price on January 4th, well, the year hasn't ended, but if you look at the yesterday closing price, that S&P 500 index tracking ETF is up by over 25%. So you see, Some years you will do well, some years you won't do well. The trick is you need to jump in and out where there are opportunities. Never make that mistake of staying longer than you are welcome in the market, because the last thing that you want is to give back your profits. You see, don't want you to give the profit. I see that now there is someone who's watching the live. I don't know who's that person, but if you are watching, just please give this video a thumbs up so that I can see that you are still here with us, you are paying attention. Just kindly give us a like there. Then what else? Okay, we've spoken about it. It's possible to pick the index. We've spoken about what can you buy to get the average market return. Now I'm forgetting what it is that I wanted to talk about. Oh, okay, maybe let's just talk about rent cost averaging. You see, there is nothing wrong with rent cost averaging. We're not going to say dollar cost. We are in South Africa, we mostly invest in rents. So let's try to keep it local. Rent cost averaging simply means that we are speaking in the context of top 40 ETF. January, you contribute, let's say you contribute 500. Each and every month, you get cash. You buy the JSE top 40 without fail. You don't second guess it. All the time, you just keep on buying it, buying it, buying it, buying it, buying it. Yes, there are some times where you're going to get more ETFs, unit of that ETFs. Then there are some times where you are going to get few of the ETFs, but in the long run, you are going to make money. We have a video where I was saying that if you are just starting out as an investor, you can just simply buy the Satrix Top 40 ETF, and then you're going to make money. You don't need to worry about beating the market or researching on companies. You're just buying the same thing. But now the problem with us as human beings, we love thrill. It's boring. You're just gonna wait for your pay date. Let's say you get paid on the 25th of the month. So you wait 25th, you are paid to transfer money to your account, or maybe you even set up a debit order. The money gets in, it buys you Satrix top food. Then from the 26th until the next 25th, there's no action that is happening. So people don't want that. We always like action, you see. So we need to save ourselves from ourselves, because it's us who are shooting ourselves in the foot by not wanting to sit in there and do what the professionals recommend. Not to say that the professionals are giving us the very best advice, but yeah, it's not a nice thing. Well, it's none of my business, but it's not a nice thing when I'm browsing on my Twitter timeline, then I see somebody, maybe they had 100 rand to invest, then they split it to 3 different companies. They put 30 rands there, 40 rands there. Let's say, okay, I see Paddy Padayach is asking who is in this call. Hi, Paddy Padayach, it's me. It's Trend Trader that is on this call. Yeah. So if you have less amount of money to invest, less than 500, don't try to stretch it between a lot of companies, because you're not just going to get the best return out of your investment. Yes, it's nice to be in a lot of companies, but remember, if you buy S&P 5, not S&P 500, Satrix Top 40, automatically you've invested in 40 companies at once. So why would you want to split your 100 rand to 3, 4, 5, 10 companies? It's not going to work. You see, patience. Patience is important, but yeah, I understand, because very few people can do that. I myself, I struggled, so I understand if other people are struggling. But yeah, let's just wrap it up there for today. In the future, we'll try to schedule the streams. Hopefully by that time I will also have a better PC that I can use to stream and be able to show the chat. But for today, the webinar, well, the webcam, I think it worked. We didn't have a lot of people to ask questions beside the question on who's on this call. But if there were people asking questions in the comments, maybe about the stock market or anything, I would have answered their questions. Or maybe in future I should try to have these sessions where we schedule well in advance so that people can be there and they can pitch up and watch the video live and ask questions, and then we discuss whatever that they would like us to discuss. But until then, we're just gonna wrap it up here. I'm going to upload this video and remove all the other attempted streams that we did earlier. Some of the videos were like 1 minute. Then in future we will schedule it so that we have more people and more people can come up with their questions, or even people can bring or can give me their questions up front before we start the stream. So I'm just going to end it now, because if I don't end, I'm just going to keep on talking until there are 10 people, then I won't be able to exit. Well, I don't know when you're gonna see this video, but whenever you see it, if you enjoyed it, if you found value in it, please like. If you have subscribed, don't do anything. If you haven't subscribed, please consider subscribing. Please help us grow this channel so that we can reach more people. Okay, I'm ending it now.